Hey, it's Sandy Matson, eXp Realty, and we have Kelly Dooley with us today. Welcome back, Kelly. Kelly's with Cardinal Financial, and today's episode is about how to, just to know more about the types of loans that's out there. I know last time we talked about how to get approved for a loan, so now I'm excited to see what loans are available to us.
Absolutely. Sandy, thanks so much for having me. It's a pleasure to be here. So yes, as Sandy alluded to, the last episode, we talked about the approval process, how long it takes, what you need. Now, episode 2 is, okay, I'm approved. So now what loan type is best for me? And I'm going to go through those loan types on a high level view for y'all. So let's start out with FHA. A lot of you have probably heard the FHA loan. It's really the most common first-time home buyer loan, okay, because it requires the least amount down, so 3.5%. So when you buy a house, let me back up a little. When you buy a house, it's broken into really two figures: your down payment part, and then the closing cost. Okay, so when you buy a house, no matter what loan program, really, there's two costs: the down payment and the closing costs. And I will cover the closing costs towards the end. Now let's go through the different loan types. So FHA, that requires 3.5% down. And what I mean by that is you take, let's say you're approved for 300,000, you multiply 300,000 times 3.5%, that's your down payment. Okay. FHA is really the most common first-time home buyer loan, because it has, you can go down lower on credit score. We can go down to a 620. Also, it allows for higher debts, or if you have more monthly debts. We talked about in that last episode, DTI, or debt to income ratio. FHA, just so you know, we can go up to a 57. Not that it matters to you. Conventional loan, it peaks at 50. So you can have a little more debt with an FHA loan and a lower credit score. Okay, so that's FHA. Next one down is conventional. So conventional typically is maybe for obviously the people that have a little more money to put down, because it's a 5% down minimum. Okay, so 5% down minimum on conventional loans. Also, conventional likes a higher credit score. What is that? I would say around 700 or higher. Conventional loan typically likes that, and what I mean by that, it's cost effective. It'll cost you less when it comes to rate when you have a higher credit score for a conventional loan. Okay, but yes, we do have a 3% down conventional loan. Not to get anyone confused, but that's reserved for really high credit, like closer to 800, and a first-time home buyer is reserved for that 3% down conventional loan. Okay, so that's your conventional loan. Then there is the VA, which all you probably know is for the military personnel out there. VA loans require zero down, okay, zero down, but the borrower, the VA, still is responsible for the closing costs, okay? Excuse me. And if you're a VA eligible person out there, or buyer, you know this, the first thing that we need, or Sandy needs, if you talk to her first, we need your DD 214. DD 214. Once we get that, we send it into the VA just to confirm your eligibility. Okay, so the pros of a VA loan, obviously, besides the zero down, is there's no PMI, and I'll talk about that. The private mortgage insurance, there's no PMI on a VA loan, and VAs we can go down to a 620 credit score. Okay, so there's the VA. There is USDA. Okay. Don't do a lot of those here in the Houston area. Those are reserved for more of your agricultural parts of Texas, farmland. You're on some serious acreage. And those are beneficial because it's zero down as well, but the borrower really needs to have very minimal debt and high credit or a good credit score. And also, really, there's a website myself as a lender, we go to. If you're looking at some properties, we have to enter that address to make sure it's USDA eligible. Okay, so you're not going to get a USDA loan in a suburban neighborhood. Okay, so those are rare occurrences when we do USDA loans. Then also there is the jumbo loan. Okay, jumbo loans, and I can give you these numbers here. So there are loan amounts. Okay, I'm not talking about purchase price. Talking about actual loan amounts after your down payment. So FHA, they raised it actually this year. You can go up to 472,100 loan amount, okay, for FHA loan. So after 472, so 473 up to 726,100 is a conventional loan. That's the loan limit for conventional. So anything above 726,000, it's considered a jumbo loan. Okay, so jumbo loans, they require higher credit score, 680 minimum. We do have some 10% down on the jumbo loans. Typically, you're going to get a better rate when it's 15% down for a jumbo loan. And jumbo loans are a little trickier because there's investors involved that we have to work with that lend the money out for those. They require more reserves, maybe 3 months or 6 months, depending on your credit score. So it can be done. It's just a little bit more work to do on the borrower's end. So that's jumbo. Then the last one, which helps a tremendous amount of buyers, is called the DPA, or down payment assistance loan. So we're an authorized lender with the state to handle these DPA loans. There's 3. Guys, you got to know there's really hundreds and thousands out there that offer grants or assistance. They're not as efficient as these 3 that I'm about to mention with the state. That's TSHAC, TDHCA, and SEC. Really, what happens on a DPA loan to get qualified for that? You have to have an income of 99,000 or less. That's household income. If it's one person applying or 2 people, so 99,000. Still the 620 credit score and the 2-year work history. So, because a lot of people, they have the work history, they have the credit score, but they may not have enough for the down payment and the closing costs, right, Sandy? So right. The DPA comes in handy because it will cover your down payment. Okay, that 3.5%. If it's a conventional loan, 5%. It'll cover a big portion of that. The buyer is just responsible for the closing costs, which saves you a tremendous amount of money. So I tell people, and I tell Sandy this and other realtors, if you get someone that has roughly 10,000 and they have the 620 credit score and the good work history, we can get them in a house. Okay, that's really what you need to utilize the down payment assistance loan, is save up that 10,000. Of course, with the work history and the credit score, we can find you something. Okay, so how it works, though, just real quickly, on the TDHCA, that I reserve that really for my older buyers that may not move again, or people that are going to stay in that house roughly 10 years or more. Because what happens is when you sell that house, you have to pay back the financial assistance to the state, whatever that is, the 8,000-9,000, whatever that is. It comes out of the proceeds. Does that make sense? You're not writing a check. If you make $50,000 on the sale of your house, 8 of that will come out of it, or whatever the assistance you got comes out of that. Okay, so that's how that works. The TSHAC, basically, I reserve that for my first-time buyers or people that are going to stay in at least 3 years. Because after 3 years of successful monthly mortgage payments, you get to keep the proceeds, or you get to keep the assistance. So when you sell your house, after the 36th payment, 3 years, you get to keep the proceeds. It's a great program. You're like, well, Kelly, how's this possible? How do they make their money back? Well, there is a catch. There's no such thing as free money, right? So what happens is the state will charge a little bit higher interest rate because that's how they make their money back. Okay, so for instance, right now the rates are averaging 6.5%, let's say. It's usually on average about a full point higher than the normal rate. So just so you know, that equates to about 200 to 300 a month more on your mortgage payment. But a lot of people don't mind that because they don't have the down payment part, the $8,000 to $9,000. They don't mind a little bit higher interest rate if that's going to help them get them in that house. So after 3 years, you can sell on the T-Shack, or you can refi. Okay, so just so you know, it's a great program. So don't discount the DPA loan. Now I do want to talk about, lastly, PMI, or private mortgage insurance. A lot of people hear that. PMI, we have zero control over, guys. The only way to get rid of it when you buy a house is to put 20% down or more on the house. That will rid the loan of PMI. So PMI is based on your credit score, the type of loan, how much you're putting down, your DTI. We have zero control of it. We basically pick the cheapest PMI. There's about 6 servicers out there, 12 lenders that do PMI, and we pick the cheapest one. So, but it is important to know for those of you that have the 20% and can put 20% down on a house, it's not always a good thing, because if you have decent credit, I've run numbers for people. If they do 15% down and save that extra 5%, and they've got good credit, I can tell you what your PMI is going to be. I've had borrowers where it's only $19. Why put that extra 12, 13, 14,000 down when your PMI is going to be $19? So that PMI will go away eventually on conventional loans. Okay, that's the caveat. Conventional loans, the PMI is going to go away eventually once your house hits 20% equity. Or if you're an FHA loan, it's going to stay on there forever. So you sell the house, or we refi you into a conventional loan. So I hope I didn't blow anyone away with that concept. So PMI is a necessary evil. The only way to get rid of it is put 20% down, or if you've got high enough credit, it's not going to be a big deal. Anyway, so I hope I explained that well enough. Sandi, do you have anything that I may have missed?
No, I don't have any questions coming through. I think that's a great way to kind of explain the pros and cons of each, because it depends on what the buyer's focused on. Are they focused on that monthly payment, or how much do they have to put down? So it's great that you've explained the ins and outs of the different programs that's available, because it's easier than ever to get someone into one of those programs.
Absolutely, it really is. And there's people that are on the fence. They may have like that 680 to 700 credit score, and they have the money to do a conventional loan. I've run numbers, and I give people options. Look, here's how much your monthly payment's going to be on a conventional loan, but your PMI is going to be $250. Whereas FHA loan might be your better route because the PMI is only going to be 80 or 90.
Right.
Yeah. And you put less down. So there are those instances where I do like to educate borrowers, hey, here's the most cost-effective route if they have that option. So there are those ways out there for them to think about.
Yes. Great. Well, thank you so much for joining us today, Kelly. I can't wait for next week. Now that we know which loans are out there, we're going to talk about the actual process of buying a house next week.
Yes, I cannot wait. So yes, don't stay tuned, guys. So what we'll do is, once you're approved for a loan, we figure out what loan program best fits you. Then we're going to talk about, well, what's it actually look like when I find a house, or Sandi, and you find a house, you put the offer in, the negotiations, etc. What does that look like? So stay tuned for that next episode.
All right. See you guys. Smash the like button.
Bye-bye.
Bye.